Hey everyone, welcome back to another episode of What Works Wednesday. My name is Leland Gross. Today I want to talk about an investing strategy that I think is really critically important to all investment portfolios, but is so rarely talked about, and most financial advisors can't do it. It's called tax location. So you'll often hear in the investing world about asset allocation, which is really the idea of diversification. So let's just throw in as many words that end in cation as we can. But diversification, we all know, don't put all your eggs in one basket. So if you're, holding a technology stock, you also want to have a healthcare stock because those are different sectors, so they move differently. Same with financial services, blah, blah, blah. So you create funds, index funds, mutual funds, or just buy enough individual stocks that allow you to spread out your asset allocation to where your assets are in real estate, technology, agriculture, health insurance, financial services, all of the above, keep going. So that, when one is down, one is up. It's the idea of, if I bought sunglasses and sunscreen, well, on a sunny day, I'm doing great. But on a rainy day, I don't need any of those things. So I'm not diversified. Both of those things are great for sun. But if I had sunglasses and an umbrella, well, now I'm diversified. I have something for sunny days and rainy days. Same thing in your investment portfolio. So that's asset allocation. How are we going to make sure the assets you hold are diversified and allocated into different sectors, different strategies, things like that? Lots of people talk about that. It's very important. Today is about tax location as opposed to asset allocation. And this is a little known, talked about strategy that, again, is very important. But the reason it's not talked about as much is because many financial advising institutions aren't compliantly set up to talk about taxes. So they say, we don't give tax advice. We don't do tax planning. Talk to your CPA. And many CPAs are looking at your greater income taxes, not how your investments are strategized to become tax efficient. So tax efficient investing, there's lots of ways you can do that, but it's important because your investments, especially if they're held inside of a taxable brokerage account, are kicking off income, dividends, interest, capital gains every year, which is increasing your taxes. So you think I just get taxed on my salary or the income I make, but really this goes into the income you make, and it can be really detrimental over time. So tax efficient investing strategies allow you to say, let's get that growth. Let's continue to grow your money. That's the whole point of investing. But let's do it in a way that reduces your lifetime taxes. Let's do it in a way that says, let's be intentional and make sure that we're not getting overly taxed right now, that we're looking long-term and saying, how do we keep your after-tax return? Because if you are making 10%, but ineffectively paying 25% on that money, really you're only making 7.5%. So if we can say you made 10%, but we were able to do that efficiently, and now you've kept 9%, your after-tax return is higher, what you actually took in. So asset allocation, risk return, diversification, tax location says, now that we've gotten that return, is it structured in a way that most of that stays in our pocket, or are we kicking that off in taxes? So let's talk how do we do tax location? Each investment type is taxed differently. And this is a podcast, so we're not going to go into CFP, CFA level courses on that, but mutual funds get taxed every year. If you are a part of a mutual fund, if you invest in a mutual fund, the fund itself distributes its earnings each year to each shareholder. So you have annual 1099s. But then also you have your share, your specific share of that fund, and when you sell that, you pay capital gains. So it can create a double tax event. So mutual funds held inside of a taxable brokerage account may not be the most tax efficient for you. Whereas we can put them, mutual funds, inside of, say, like an IRA, or even better, a Roth IRA, where those buckets are tax deferred and tax free, meaning you don't have to pay taxes year over year on that money. It shelters it. So a vehicle where you would have to pay annualized taxes and then also taxes whenever you sell can go inside an IRA, and inside of a traditional IRA, you only pay income tax when you pull the money out. Or in a Roth IRA, it's just always tax-free. Roth IRAs are always going to be the trump card because of the tax-free benefit of them. So mutual funds may be better held inside of a tax-deferred account. But let's talk about individual stocks. See, individual stocks don't tax you every year, except maybe on a dividend. So if it's a dividend-producing stock, you have to go deeper and say, is the dividend income taxed or capital gains taxed? But stocks and exchange-traded funds typically, on just high level, only give you capital gains taxation on the earnings you make when you sell, not annually. So let's break that down. Capital gains is an advantaged tax. It's a tax advantage status. So if you might be in the 25% tax bracket or 24, your capital gains bracket is probably only 15. So you get taxed less than your income tax, and it's only on the earnings. So if you put in 10,000, it grows to 15, you liquidate it. Now you're only paying that 15% tax, and it's only on the 5,000 you made. So much lower. So we don't necessarily want to hold individualized stocks inside your tax sheltered account. Because again, inside of an IRA, anything you pull out is income taxed. So if I have a stock in there that typically I would only pay capital gains tax and only on the earnings, if that's in an IRA, well, now I'm getting income taxed when I take it out, as opposed to getting that sweet tax advantage of the capital gains. You lose that tax advantage inside an IRA. So stock and exchange traded funds are actually really efficient to be inside your brokerage account where there's no tax shelter, because their built-in tax status is already efficient. See, I'm throwing a lot of words at you. You might be listening to this like my eyes are glazing over. But investments themselves have ways that they get taxed on their own. Stocks, mutual funds, insurance, real estate. And then certain accounts can trump card that. So an IRA trump cards however the investment itself is taxed. And so when an investment goes inside an IRA, it now follows the IRA rules, not the investment rules. Same with a Roth IRA, same with a 401k. Or with a taxable brokerage account, it doesn't trump card anything. It just follows the investments. The investments get to determine how they get taxed individually. So you really want to look at your asset allocation first, because again, it may not be the most tax efficient to have stocks inside your IRA, but if your retirement plan needs high growth, high risk, high return, maybe you do need stocks in there for the asset allocation plan. That will come first. Your risk, your return, your diversification, all of that is number one on the priority list. But then you take that second step into tax location and say, all right, now that we have that, how do we position these things? Some people will put real estate inside a Roth IRA. There are some places that can do that. So when you're getting rental income, it's tax-free. Wonderful. But then you lose the ability to write off the losses on real estate. That may not be wonderful. So you have to look at the tax location. Where are these investments being held? And is that imposing a new tax rule on him? And if it is, well, then is that a good rule or a bad rule? Bonds are the last great example I'll give because they're safe and they produce interest income. So they're steady streams of interest. Think high yield savings account, but bigger. So your bonds produce income for you every year. Great tool. But if they're just in your brokerage account or they're held independently, you're going to get taxed on that every year. But if you put bonds inside of a Roth IRA or an IRA, you're not going to get taxed every year. You're only taxed when you access that money, however much you need. So you can control how much income tax you get. So in general, interest-bearing vehicles that produce income level tax are great to be in IRAs, Roth IRAs, 401ks, things like that. Capital gains vehicles like stocks, exchange-traded funds would be great inside of a brokerage account because you'll get that capital gains advantage. Mutual funds are somewhere between because they do get double tax, but it is capital gains. So you kind of want to look at what that tax would be and where it makes sense in your plan. And then ultimately, all of this is going to come down to where are you in your life cycle? What's your liquidity need? What's your risk return asset allocation? So I may have made your eyes glaze over. If you take away anything, hear this, that investment accounts are a trump card to investments themselves. All of them get taxed, but investments have their own tax codes. And then when they're held inside accounts, the accounts kind of trump that and take over. And so it's just important to do your due diligence when you're doing investment management to say, I want to get the best bang for my buck. I want to grow my money well, and I want to keep it. It's not always about what you make. It's also about what you get to keep. And so to generate a higher after-tax return is really, really powerful. Okay, so with that, go forth, make sure your investment portfolio is correct from an asset allocation and a tax location standpoint, and prosper.